You seem 100% certain about what you're talking about.
That means that you're going to lose 95% of your wealth. What's the answer? The issue with Peter's not offering a solution to the world, right? He's simply trolling Bitcoin. For example, he's got more investment in gold stocks, gold miners than gold. Well, gold miners are short gold. The fundamental point here is you have to give the world a solution to their problem, not just be a critic. If you want to be a critic, you can criticize everything, but what's his answer? If you listen to Peter's debates, what he says is he only has 5% of his portfolio invested in gold, which means that he has 95% invested in something else. But what is the something else? And the point is, you're back in this same, hedge fund shuffle mentality. It's like, just give me all your money and I'm just going to shuffle it with random 95% opacity on random stuff back and forth, but don't question it. What about the 5? If it was a recommendation, he would own more than 50% of his portfolio in the gold, but he doesn't believe in it.
But his argument would be, I don't recommend people to buy 50%. I recommend people to buy 2 to 5%. That's his position.
He doesn't have an answer to that means that you're going to lose 95% of your wealth. So what's the answer?
So, and your point is diversifying.
And by the way, I have a debate. If you go online and you Google Michael Saylor gold debate, you'll find a pretty good debate that's got more than 2 million views right now, where I go point by point through the differences between Bitcoin and gold. The issue with Peter's not offering a solution to the world, right? He's simply trolling Bitcoin, and he's not trolling Bitcoin with any real concrete criticism other than he just doesn't like it, right? Peter is anti-everything. For example, he's got more investment in gold stocks, gold miners than gold. Well, gold miners are short gold. Gold miners' incentive is to dump as much gold on the market as possible, as fast as possible. If you read the balance sheets of the gold miners, what you'll find is they don't hold gold as an asset. So gold miners don't believe gold is money. If they did, they wouldn't sell it, they'd buy it. And Peter doesn't believe gold is money. If he did, he wouldn't allocate 95% of his wealth to something other than it. And ultimately, the fundamental issue with Peter is, he's just debated, he's debated this issue for a decade. All of his argument is just, I don't like Bitcoin. He hasn't come up with anything worth refuting that I can see. And if you go online, you'll find 3, 4, 5, 6 Peter Schiff debates, and he just doesn't say anything other than just bark. I can't see it's constructive. This is a reasonably constructive debate if you go to me and Frank Giestra, where we actually had a lot of back and forth. Fundamentally, though, find me somebody in the world that has invested more than 50% of a portfolio in gold at $1 billion level. My position is pretty clear. I've invested almost $4 billion in Bitcoin, and I'm not telling you need to invest half your portfolio in it. I'm just saying that I think that it is money. It is an asset. It will appreciate in value, and one can create a strategy where it is the dominant part of the strategy. There are other people that have invested in companies. Amazon was Jeff Bezos' strategy. I get it, big tech. Other people have bought city blocks in New York City. That's a valid strategy. So investing in property or investing in technology is a valid strategy. But on the other hand, find me someone that has actually bet $5 billion on gold, where it constitutes more than 50% of their portfolio and it's their own money. And Peter's not one. Peter hasn't bet on gold. Peter's betting on gold going down. He's buying the Bitcoin, the gold miners that are dumping the gold, making the gold price decay. So that doesn't make any sense. If you dig into the gold miner balance sheets, read the 2, 3 biggest gold miners, what you'll find is they overmine the gold, dump the gold, then they pay an income tax, then they dividend out their excess and pay a dividend tax, then they pay off their debt, which is 2%. So another way to say it is they would rather loan money out to the world for 2% interest than hold gold. That's how bad they don't like gold. The fundamental elephant in the room here is when the currency collapses, give me a diversification strategy for Russian stocks right now. Which of those do you want to own? When the currency collapses, the bonds collapse that are linked to the currency, all the companies that generate cash flows in the currency, they all collapse because they're valued as a stream of cash flows. And if the cash is worthless, how is the company going to be valuable? You sell beef in Argentina, the peso collapses, the people are buying the beef in pesos, so you want to sell the beef to Europeans for euros. The government passes a law keeping you from selling the beef or exporting your beef. Export controls come, wage and price controls come. So the problem is every equity, every piece of debt, every piece of property linked to the currency is correlated correlated to the currency. So your diversification strategy with any given currency, whether it's the peso, the dollar, the euro, the ruble, the lira, the whatever, they're all correlated. So then you're like, okay, well, this is great. I'm just going to buy the dollar. All the currencies are correlated to the dollar, and the dollar's collapsing. How fast is the dollar collapsing? Well, you can watch it against real estate in Miami Beach, right? You can watch. All you got to do is look at the dollar versus any scarce desirable piece of property. So what's the dollar valued in versus a Picasso, a Leonardo da Vinci, a city block in New York City, a desirable piece of beachfront property, and how about Palm Beach, right? What's happened to Palm Beach property in the past 10 years? So ultimately, the problem with diversification is nearly everything, every stock is correlated, and every conventional asset is generally correlated. The only true diversification is if you find non-sovereign stores of value that derive their value based upon something other than the cash flows that you could derive from them, right? So think hard about what those are. Pristine trophy properties might protect you.
You seem 100% certain about what you're talking about. Are you 100% certain about the future of Bitcoin and that it has zero risk? There's no risk that could do anything to it?
I don't think you can state that. No, I think that everything in life has risk. So there's a black swan risk, an unknown, and anybody intellectually honest has to admit that there is that risk. That's not what I would say. What I would say is you've got a bucket of money. Let's come back to Africa. Okay, you've got $100,000 in Africa. You've got to invest it in something. You've got to put it into a building, into land, into an African currency, into something else. What are you going to do? There is 100% certainty that you're going to lose 80% of your money in most currencies over the next decade. There's 100% certainty you're going to lose 95% of your wealth over 30 years in just about every currency. And so you have to work through each of these issues and say, what's the cost of doing nothing? What's the cost of not taking a risk? What's the risk-free rate? Well, the risk-free rate is the monetary inflation rate. So the price that you pay to not do something is the rate at which the money is collapsing. If you were a Russian, they just lost 35% of their wealth by not doing anything in the matter of weeks. So in this particular case, you just have to look at the array of options. If you're an investor in South America or Asia or Africa, I would say the risk-free rate is much higher for you, right? Like you're in Lebanon, what are you going to do in Lebanon? How about Afghanistan? How about Iraq, right? What are you going to do? In all those situations, they're thinking, maybe I'll trust my money to Tether. Tether's run by Bitfinex. It's just a company. So why is it that people in many countries are more willing to trust a company out of Hong Kong that's running a stable coin on the crypto network than they're willing to trust their local bank? Well, because in fact, Tether is probably a better bet than betting your money on most currencies in the world. Other than the top 12 currencies, the rest are collapsing.
Why do Tether if you can just do the US dollar or USDC?
Well, you can't. That's the point. Why do Tether if you could just do the US dollar? Okay, how many people in Africa can walk into a Bank of America in New York City, open an account, and then get the US dollar? None of them. That's the whole point, right? And okay, I did it. I'll give you an example. I put $1 million into Bank of America in Argentina when the dollar was worth 1 peso because I didn't trust the peso. I did it. What do you think happened? The government basically shut down for 1 day. They sent an edict to the bank saying all dollars must be converted back into pesos. Then they went off the dollar peg and they devalued the peso 10-1, and I lost 90% of my money. Okay, so why do Tether instead of trust Bank of America in Argentina? You tell me, right? Because what's the odds that Tether is going to go to zero in the next year? If the odds were 90% your money is going to zero in the next year by putting it somewhere else, then you would think maybe that's a risk I want to take. So, people are forced out the risk curve based upon the monetary policy, and in a hyperinflating economy in Zimbabwe, right, you're going to take everything you've got, you're going to buy anything, right? The reason that Bitcoin is magical is because there's only 21 million. I can create more real estate in New York City. I can create more cars. I can create more luxury watches. I can create more gold. I can create more shares of stock. I can create more bonds. I can create any commodity. They're commodities by definition. Given enough money and time, I can create infinite of any of them. Bitcoin is a scarcity, okay? Name another scarcity in the world, right? And technically, it's not clear there is another scarcity, right? A scarcity is something of which it is absolutely capped. If the price goes up by a factor of 1,000 or 1,000,000, it is absolutely capped. That is not the case with gold, soybeans, silver, stock, bonds, real estate, single-family homes, ships, planes, trains, nothing else. Everything else could be manufactured. And of course, if the price goes up, the incentive to manufacture more will go up, which is why, buying a house isn't necessarily going to be a great store of value in an inflating economy, because you're going to have incentives for someone else